Phil Weiss of Replies Wealth Management here with a video summary of this week's blog, Individual Bonds or Bond Funds, the Changing World of Fixed Income Investing. I call it the changing world of fixed income investing, but what's changed? We were in a low interest rate environment for years. Rates were falling, and they kind of leveled off. You couldn't earn much from fixed income investments. Led to phrases like TIN, which is there is no alternative, which is why some people were trying to avoid or lower their bond allocations to increase their allocation to stocks because they just couldn't make that much for bonds. But now rates have moved up. In a higher rate environment, I talked a couple weeks ago about places to park your short-term cash, and among those were short-term treasuries, which you could get a nice interest rate better than you could before, and at least you could earn something on that cash. But what else has changed? Is it time to invest, or should you think about investing in individual bonds? And that's really what we're going to talk about in this blog. First, to take a look at bond prices and interest rates. It's important to remember that bond prices are values and interest rates move in opposite directions. In other words, when interest rates increase, bond prices fall. That's the environment that we're in now. But in the prior environment, when interest rates were falling, bond values went up. Some other factors to consider in this whole equation. Remember that if you have a bond fund, there's a time lag in terms of when they're going to pay current rates because they already hold bonds. They're not going to just get rid of everything to get the current rate. So that means that the rate that you get on a bond fund, the yield, might not be as good as what you get on the individual bond. But then there are still advantages to bond funds. Easier to manage, more diversified than you can be on an individual basis. The expenses are likely lower. Harder to tax loss harvest if you own funds as opposed to owning individual bonds. But with individual bonds, you may want to just hold them to maturity, so maybe that doesn't matter that much. Individual bonds, you do have more ability to control the term. You have more ability to just buy it, hold it to maturity, which in essence can impact your view of volatility in terms of how those bond prices change. I talk about bond ladders, which is buying bonds that mature over a sequence of years, typically, so that way is 1 year matures, you replace it with another. You buy 5 years worth of bonds, 1, 2, 3, 4, and 5. When year 1 matures, you buy new 5-year bonds because everything else, the 5 goes to 4, and so on down the line. I provided an example of how all this might work in terms of what you might pay and how the mechanics of how the change in price is affected by the yield. And then some other considerations, including the risks. There's greater risk with owning individual bonds because you have more default risk. There's something called call risk. In the end, it's not a simple decision. For most investors, it probably still makes sense to continue to hold bond funds. But if you're willing to consider the additional complexity that comes with it, to own some individual bonds, they can make sense. They can definitely be a way to boost your yield. So I hope that you find this week's blog helpful. It helps you in deciding if it makes more sense to own individual bonds or bond funds. I'll be back next week with the Prize's 5 favorite reads of the week. Thanks for listening and have a great day.